Brilliant. So good to see so many people coming in. Just to say, we're going to be just waiting around a minute or 2 minutes just to let everyone come in, and then we'll be kicking things off. So we'll be starting shortly. And also just to say, at the end, we're going to be doing a Q&A. So if you do have any questions, please put them in the Q&A section or in the chat, and we'll make sure that we go through them all in turn. So yeah, it would be great to answer any questions that you do have. We'll be happy to go through them. So yeah, please use that Q&A feature. We're here to help, and yeah, we'd love to answer any questions you have. And also, I have in my own background, and maybe it will appear during the Q&A, I've got QR codes for all of the different tools and links that are involved in this webinar. So yeah, please use those, but there are also links will be appearing in the chat as well. So afterwards, if anyone would like the recording as well, we'll be sending that out. So yeah, please do get in touch if you would like the recording to any of us, and we'll be happy to send it over to you. So I think now's a good time to kick everything off. So firstly, just want to say thank you everyone so much for coming. The aim of this webinar is for us to help you get prepped for filing your tax returns. So we're going to be helping you with tips and tricks to get on top of your finances and make sure that your money works as hard as you do. So we've assembled a panel of experts to walk you through everything you need to know about tax, accounting, and pensions as a self-employed freelancer. My name is Joe Scarf, and I'm the Chief Marketing Officer at Twine, which is a global community of creative and digital freelancers that we connect with clients for paid freelance work. So if you'd like to check out the work that we've got, please go to twine.net/jobs to see all of the freelance jobs that are available. But to kick things off, I'd like to pass you over to Chris, who's going to take you through the agenda for today's webinar.
Great, thank you very much, Joe. And yeah, great to be here, and thanks everyone for tuning in. I'm Chris. I'm one of the founders of Penfold. We are a pension company, just for the self-employed. So trying to help those who work for themselves to save for later life, because it seems seemingly very hard to do that, and so we wanted to solve those reasons why that's difficult, and help everyone save enough for later life. So that's what Penfold is, and we'll come on to more of that in a minute. Today's session, as Joe says, is around your tax year end toolkit. So the tax year end is coming up on the 5th of April, and so we've got a month left. So really, it's a really good opportunity for us to run you through the things that are helpful to be thinking about at this time of year. Firstly, in terms of your taxes. So as you can see on the agenda, we'll talk about some of the key dates around the tax year, what you can be claiming on expenses, ways to be reducing your tax bill as much as possible within the current rules, reasons why to do your tax return early, and the latest on the government grants that were announced yesterday. And then we'll switch gears and start talking about pensions, because pensions are a fantastic way not only of saving for later life, but also to reduce your tax bill today, particularly when you're self-employed. So I'll then cover the basics of pensions, how tax relief works for pensions, the magic wand, which is compound interest, and how to transfer pensions. And then we'll have some Q&A. So a lot to cover. We'll try and cover it quickly and helpfully, and then we can open the floor up to questions. So just very quickly on who we are. So Penfold, as I say, flexible pension for the self-employed. We try and make it as easy as possible to get going, to set up and open an account and start saving. We add your government tax relief, your 25% savings bonus for you can pause, change, or the amount that you're paying in at any time. And we've got a really friendly, helpful team of experts to help you with any questions that might come up. And you can combine all pensions for free. So it's just a few things about what Penfold is. We're a fully regulated pension company with all the protections that other pension companies can offer you. And then move on to Tax Scouts, who are the other. And I'll pass over to Hannah for this bit.
Hi, I'm Hannah. I'm an accountant and I work with Tax Scouts. So Tax Scouts is an online service and you can log on. It's all online, it's low cost compared to other accountants, so it's £119. When you sign in, you get asked a couple of questions, takes you roughly about 5 minutes. Depending on your answers, the system would then ask you to upload some documents depending on your circumstances. And then you get passed on to your accountant, who will prepare and file your return for you. Once you're allocated an accountant, you get their mobile number and their email, just in case there's any questions you want to ask. So answer a few simple questions. You get paired with your own accountant. That's your accountant every year. It never changes. So you've always got the same person, and then you get your self-assessment filed for you. So now I'm just going to begin taking you through the basics of tax. So the first things first, what you need to know is the dates for your diary. So every tax year runs from the 6th of April to the 5th of April. You need to register with HMRC by the 5th of October in the following year, the following tax year from when you started. So if you were to go self-employed today, you would need to be registered in the next tax year, which is 6th of April, and you'd need to register by the 5th of October. Your tax bill is usually due to be paid in January. Some people have a payment to pay in July, which is a payment to account, but I'll cover that later on. And as I've said, the deadline is 31st of January. You can file at any time from the 6th of April. I always recommend doing it early, just so you know what you owe, and then you don't get a nasty surprise if you leave it to last minute and you get a big tax bill. So you can earn £12,500 each year before you need to pay income tax, but this doesn't include national insurance, as they have their own thresholds. If you're employed and you start a side hustle, you can earn £1,000 in a tax year before you need to register with HMRC and declare it. So that's £1,000 in total. It's not a £1,000 profit, and each year that refreshes. If you do earn more than £1,000, then you need to register with HMRC as self-employed by the 5th of October the following tax year. So if you commence trading on the 1st of November 2020, then you need to be registered by the 5th of October 21. There's also the £1,000 allowance. I'll talk about it later on. It's basically a trading allowance, which is why you don't need to register, because you'd be covered by that. So as an example, Laura is a self-employed hairdresser. She works out her income and expenses and works out she has an £11,000 profit. She thinks that because this is less than a personal allowance, that she doesn't owe any money to HMRC, when in actual fact, if you have a profit over 6,475, you need to pay Class 2 national insurance. So this is your pension stamp. It covers your pension when you get to pension age. It's £3.5 a week. So she actually owes £158 in national insurance for Class 2. Self-employed people also pay Class 4 national insurance, which is 9% on profits that go above £9,501. So she needs to pay 9% on £1,499. So she owes Class 4 of £134.91. So she thought she owed HMRC nothing, when in actual fact she owes them £293.51, which is just national insurance. So everybody loves expenses because it gets your tax bill down. More expenses, lower tax bill. What you can expense depends on your business. So if it's not relevant to your business, then you can't claim it. If your expenses are minimal, what I mean is if they add up to less than £1,000, like some people only have £500 expenses for the year, then you just claim the trading allowance. This is what HMRC gives you. You don't need receipts, you don't need to back it up. It's £1,000 expense, no questions asked, and you use that. If you're in a household that's reliant on a single income and your partner doesn't earn a wage, then you can get benefit from the marriage allowance transfer. So you'd get another £200 off your tax bill if you use that. If you donate to charity and you choose the gift aid option, there's usually a little box that you can tick and claim gift aid. then you get the tax relief off all the donations that you've paid in that tax year also. A lot of people miss common expenses like your mobile phone, laundry bills, like construction people that don't want to ruin their wife's washing machine, they go to a laundrette, so that's all claimable. Courses that are essential, your business membership fees, your accountant fees. You just need to keep on top of your expenses really. Like if you think it's relevant, just keep a note of it and your accountant can tell you. There's loads of apps you can use to do this. I like Free Agent. QuickBooks is another one. Like these are all good apps to link to your bank and it'll log everything for you. You can claim mileage if if you don't really travel but you only need to travel sometimes, then it's no use doing fuel. Mileage is always best. And you can use your home as an office. This year it's £6 a week, which will be claimable for use of home. Or you can do the equation, which you can email me if you want to know that. It was too long to explain just now, but you can do an equation and sometimes that does work out better, but it's usually best just to use the flat rate. So do your tax return earlier this year. I always recommend this because it gives you 9 months to pay it. You can just pay chunks here and there. You don't need to pay it in full. Just pay it up as you go along. If you leave it to last minute and you find out it's bigger than you expected, then you're under pressure because you need to get it paid before the 1st of January. Otherwise, there's penalties and interest. Some people might see payments to account. A lot of people usually have no idea what these are. So a payment to account is tax payments which you pay in advance towards your next year's tax bill. HMRC ask for these if your tax bill is more than £1,000. Each payment to account is 50% of the tax that was due, and it's payable twice, once in January with your balance of payment, and then you pay your second payment in July. Both of these payments come off your next year's tax bill and bring it down. If your income is less in the next tax year and you know that your payments account are too much, you can appeal and get them lessened or took away. You can do this by asking your accountant to do it on your tax return. You can fill in an SA 303 form, or you can do it yourself and contact HMRC and they'll take it away for you. If you do take the payments to account away and it turns out you did need to pay them, they get added back on with interest. So I would only really do that if you know your income has suffered. So the self-employed grants, yesterday it was announced that the 4th grant is coming out. It's covering February to April 21, and there will be a 5th grant later on in the year. So businesses that have incurred economic downturn from the impact of coronavirus, that lost any income due to it at all, they're all eligible. And due to now including the 2021 tax return, there's an extra 600,000 people newly self-employed who will be eligible to get these grants that haven't been able to get them before, as long as they filed a 1920 return before the 2nd of March. I just want to say that these grants are taxable and subject to national insurance. So when you do your tax return, these grants that you've been receiving, make sure you put them in your tax return because HMRC will be checking. And the coronavirus job retention scheme was also extended until September 21. So that's good news for everyone that's been worrying about the jobs because it was meant to end at the end of this month. So everyone's fine until September. And I think I've covered everything. So if I've not covered anything, I'm sure I'll see it in the questions. And I'll just pass you on to Chris.
Sorry, I was on mute. Switching gears to pensions now then. So what's the point of a pension? So ultimately pension is about the best way, it's about saving enough money so that you don't have to work one day. And it's about saving up enough so that you could get financial freedom and financial independence in later life, so that you don't have to take the jobs that you don't want to take, and you can do what you want with your time. And ultimately, the best way to do that is via a pension for the majority of the population. And that's because of the fantastic tax breaks that are available with pensions, how much the government will sort of top up the money that you pay into the pension. And thanks to the magic of compound interest, which is what happens when you put your money in a pension and leave it for 30 years and it's invested and it grows and grows and grows like a snowball running down a hill. And so the thing that's relevant about this today is that we've been talking about business expenses, and particularly if you have a limited company for your earnings, you can classify pensions as a business expense. If you don't have a limited company for your earnings, you get fantastic top-ups from the government on the money that you pay into your pension. So let me just run through very quickly the basics of a pension and why you need one, and how that tax relief works. So three things you really need to know about pensions is that the government does provide a state pension. There's a formula, but basically from the age of 68, you'll receive about £9,000 per year from the government, as long as you've been paying national insurance for a sufficiently long amount of time. Now, most people would say that's probably not enough to live off, and so it's important that if you do want to stop working one day, to save up enough to provide yourself some additional income, and that's where the personal pension comes in. So the good news is, though, that the government wants you to save into a pension, so they will add generous tax top-ups to the money that you do save into your pension. And as I say, you've got this secret weapon of compound interest. So how these tax top-ups work then? If you're a sole trader, or you're just paying in from your personal bank account into a pension, if you're a basic rate taxpayer, for every £1,000 that you pay into your pension, or every amount that you pay in, the government adds a 25% top up on top of that. So if you were to pay in £1,000, the government adds £250 into your pension. So you have £1,250. And the reason they're doing that is they're reimbursing the tax that you would have paid on that money in the first place. But think of it as a 25% immediate top up on the money that you pay into a pension. If you are fortunate enough to be earning over 50k, so you're paying at the higher rate, it gets even better. You get the £250 straight away, but you also get a further reimbursement off your current year tax bill. So say this year, and you're coming towards the end of the tax year, and you wanted to pay £1,000 into your pension, you do so, you add 250 gets added, so that's the 1250 in your pension, but you also then get 250 back off the amount that you owe HMRC in your self-assessment. So the total benefit is 500 there. Again, that's reimbursing tax that you would have paid, but it's a really, really great way of, if you have spare money lying around as you get towards the end of the tax year and want to save for later life, it's a great way to get cash back today whilst also saving for later. So that's for sole traders or people who are just paying in from their personal account. If you operate a limited company, which a lot of self-employed do for their earnings, it's slightly different, and pension contributions classify as a business expense. So you get the corporation tax saving. So, for example, it's I suppose the primary benefit, or the other benefit, is that it's the only way to take money out of your pension tax-free as well. So if you were to pay £1,000 in from your limited company into your pension, you don't pay any national insurance on it, you don't pay any income tax, you don't pay any dividend tax. So £1,000 goes into the pension. But further than that, you classify that £1,000 as a business expense. So you get the offset to your tax bill, so £190 off your tax bill if you're paying 19% tax rate. And just to sort of show the alternative, I suppose, to taking cash out of your limited company is either pay yourself more salary, which has the highest rate of income, rate of tax, or take it as a dividend, which also has tax rates associated with it. So a basic rate 7.5%, or a higher rate 32%. So taking that £1,000 out of your out of your company as a dividend, you'll end up with 925 or 675 in cash, whereas paying into your pension, you get the £1,000 in your pension. Now, obviously, the drawback around pensions is, and the trade-off there is that you get these fantastic tax breaks, but you can't access the money until you're 55. So that's what you have to weigh up: is, will I need this money until I'm 55? And if not, then it's a great way of building your wealth. So I mentioned compound interest earlier as being the magic wand in terms of saving enough for later life, and it can be quite daunting to think the amount of money that you would need to be able to live off for the rest of your life after you stop working is in the hundreds of thousands of pounds, which sounds like a huge amount of money to save up. But the good news is that compound interest does the hard work for you if you can start saving early enough. So compound interest, as I said earlier, is the snowball effect that happens when your money is invested for a long period of time. So if your money tends to grow by 5% a year on average because it's invested in the stock market and it generates returns, 5% sounds like a small amount, £100 growing to £105. But what happens is the next year, that £105 grows by more because it's 5% of the total. And that's interest upon interest upon interest is what's called compound interest. And that means the money really snowballs over time. So there's an example here of if you were to put £5,000 in to a pension at age 40, you get your government top up 25%. And if assuming it grows at 5% a year until you're age 68, that £5,000 would grow to about £20,000. If, however, you paid it in 20 years earlier, so at age 20, that £5,000 would grow 10 times over that period to £65,000. So, you know, if you're in a position to be putting away that amount of money at that age, you know, you can really benefit from that long period of compound interest. But you know, it's not an example to be alarming if you're not in that position, but it's to show that you know, the earlier you start, the more your money can work for you rather than having to save up the full amount yourself. So just a couple of things on why pensions are even more important when you're self-employed. If you happen to operate a limited company, you may not be eligible for the full state pension if you're limiting your salary to the certain level, so you don't pay national insurance. So be careful if you're doing the wise thing of optimizing how much you take out of your limited company, you might not be paying national insurance, and therefore you might not be eligible for the state pension, which is that £9,000. You need to be paying national insurance for a good 20 years to get that £9,000. The other point is, yeah, everyone who has a job, a full-time job, has a pension set up for them. Some regulation came out 5 years ago, auto enrollment. So everyone, and they don't have to, where you join a company and the company will set that pension up for you and will pay into it for you. You know, no such luck if you're self-employed, and so it's really important to look after yourself. And as I say, there is extra tax breaks available for the self-employed, particularly if you have a limited company. There's, you know, a couple other ways pension saving can give you a helping hand. You can use it to reduce the sort of increase your child tax benefit, and there's a few others, but that's sort of getting into the details. We can provide some further information there. And then finally, so the small print, your contributions into a pension, there are caps. So £40,000 is the amount that you can pay in a certain year, or the amount that you earn. So if you earn less than £40,000, you can only put up to that amount in your pension. And unless you have a limited company, in which case you're eligible for the full 40,000. As I said earlier, you can only take the money out when you're 55. And when you take it out, the first 25% of what you take out of your pension is all tax-free again. And then the rest, the remaining 75%, you pay income tax on that money as it comes out of the pension, but typically at a lower marginal rate. So just a couple other things. I think most people who've may have worked in companies where they've set up a pension for them in the past and will have pension pots lying around when they don't know who the provider was or where the paperwork was or how much is even in them. This is a huge problem, and there's £20 billion worth of pension pots out there that have been lost for exactly this reason, of people moving jobs and losing track of their paperwork and forgetting where they are. So if you're in that position where you had a job that did pay into your pension, it can be a good idea to track that down and consolidate that pension into something like Penfold, where you can see it on your phone and it's there, or but to be impartial, there are other places you could do it. You know, it's one of the things we do is help people with that process, because it's actually remarkably difficult to bring your pensions together into one place. So, you know, what we do is help you find where they are in the first place, and then help you bring it together. The finding your lost pension details is half the battle, and typically you need two bits of information. It's who the pension provider was at the job that you worked at, and what your specific policy number was when you were in that pension scheme. The provider's name, good to check your emails or that you had from the company. There's a government website where you can search with the employer's name, and it'll tell you who the provider was, and we're building that into our app as we speak, actually. And then, if you can't find it there, emailing or calling the employer, and they'll tell you who the provider is. Once you know who the provider is, it's more straightforward. You have to give them a call and sit on their waiting list, sit on hold for 10 minutes or so, but they will then tell you your policy number. We can send a letter on your behalf that asks for your details, but that takes a bit longer, so it's always best to just give them a call, and then give those details to us, and we can bring it all together in one place. Finally, I should just quickly mention, we've got a couple of promotions on pensions. If you want to learn more, we've got Q&A coming up now. We've got online chat on our website. And if you're keen to open a pension with Penfold, you can get £25 added into your account if you use the referral code TWINE. And we're also running a promotion this month where if you want to transfer previous pensions to us, we'll pay up to £1,000 into your pension if you do so, depending on how much the value of the pension that you transfer. So that's everything I wanted to cover, and that's a lot of information that we've both just given you. So we will now switch to Q&A, and over to Joe.
Brilliant. Thanks very much for that, Chris, and thanks, Hannah, as well. Really excellent presentations, and I learned a lot myself there. So yeah, really valuable stuff. Thanks both for that. That was great. So we already have a number of really good questions in. If anyone wants to add any questions, please put them in either the chat or more ideally the Q&A, and we'll go through them. But I just had a couple of questions just to kick things off. Chris, I'm really curious to ask, so when you're thinking about a pension, it obviously feels like a long time away. How do you figure out what you'd need to actually live on? What would be an effective pension? And yeah, how do you sit down and actually plan that out so you know that either it's not ridiculously over ambitious in terms of what you could save, but also not way below what you could actually live on?
Yeah, so yeah, crucial question really, and it can be really daunting when you try and work these numbers out, as I said earlier. But there's a couple of helpful sort of rules of thumb that are out there that a general advice that it varies obviously per person, but these are sort of truisms that have been helpful to others, is that you typically need about 2/3 of what you were earning. And if you think of and 2/3 of what you're earning when you retire to give yourself the life that you want to live in retirement when you're not working anymore. So if you think of the level of income at which you're pretty comfortable, it might be what you're earning today, or it might be what you think you're going to be earning in 5 years' time as your career progresses. If you think of that sort of, that's the level at which I'm going to be comfortable. 2/3 of that is roughly speaking what you need as income in retirement, and you can create that income in retirement through your pension. So you know that £9,000 of that number each year will hopefully come from the government through the state pension, and that's from the age of 68. And so you need to make up the rest through your pension. And broadly speaking, you can create income from a pension pot at about 5%. So if you have £100,000 in your pension pot, you can get an income of about £5,000 out of that for the rest of your life, broadly speaking. So if you were to take the £9,000 from the state pension and have £100,000 in your pension pot, that gives you £5,000 extra, and so that gives you an income of 14 altogether. And so you're adding these blocks of £100,000 to your pension to get yourself up to the income level that is the target rate for you. So, and we've got a calculator that does exactly that, and there are others that do the same. As I say, it can spit out quite a large number. It might be £400,000 or something that gives you the income that you want, but you've got a long time to get there. So the amount that you actually have to pay in to get to that £400,000 is much lower thanks to compound interest.
Brilliant. Thanks for that, Chris. That was really comprehensive. Thank you. Hannah, I was just going to ask two quick specific questions. One was, you mentioned about the SA 303 form. How do freelancers get hold of that form?
See if you go on to you can do it through HMRC's website, but it's really quicker just to type it into Google and then type like SA 303 form. And then usually the first line that comes up is the PDF form, and you can fill it in online.
Okay, brilliant. And then also you mentioned about incidental vehicle usage. This is something that quite often videographers on Twine ask about. How is that defined? What does incidental mean?
So like if your job is, so see like taxi drivers, they'd put fuel in their car every single day because they need to drive. Like that's what they do. So they'd claim fuel because it's obviously a lot better off for them. But see for like photographers, they're just driving to venues. So they'd record their mileage and they're better off using the mileage because you can't really calculate the fuel that you've used to get to venues because they're not allowed to use the fuel for day-to-day life, just getting to the venues. So that's why you use mileage, because it's incidental. You've only done it because you're driving to that job. Whereas a taxi driver would use fuel because they're driving every day.
Yeah, thank you for clearing that up. That makes sense. Brilliant. Okay, looks like we've got quite a few questions. So let's try and get through as many as we can. So first one here for you, Chris. Was there anything announced yesterday that impacts pensions at all that might impact any of what you were speaking about?
Nothing that will impact what I was speaking about. One thing that they've announced is there's a cap on the amount that you can pay into your pension and still be eligible for tax relief, which is £1.07 million into your pension. And if you go above that, then you have to pay some additional tax charges. And what the government has done is, I mean, they brought this lifetime allowance in a few years ago, and the amount has come down a little bit. They were going to increase that allowance by inflation each year, but they've decided to freeze it at the 1.07, and I believe it's till 2026. So that's the total amount you can pay, and it isn't increasing. But that's the only real impact on pensions.
Okay, good stuff. And then on to the next question. So this is one for Hannah, I think. Can I claim part of my master's degree? It's for the job/industry I'm in.
Right, so with like education, so it's seen as bettering yourself. So if you could perform your job with just your normal degree and your master's, you've just done it to like better yourself, then no. But if you absolutely cannot do your job without it, like no one will touch you without that, then you could claim part of it. But it's really, it depends if you could perform your job like just on a normal degree.
Okay, and
it's basically seen as bettering yourself, so it's not business.
And so how do you, what's the, that sounds like that could potentially be a bit of a grey area in defining that. How do you make the case?
You'd need to prove that you couldn't get employed without it. Like, so like job applications, it says like what they want from you to take you on, and it would need to say that you need to have a minimum of this. So you needed that to work. But if it's just, you're just doing it just to like get better at what you do, then it's bettering yourself and it's not business.
That makes sense. Great stuff. Okay, the next question. I've been working as self-employed music teacher for a school in Brighton, but I was not able to get any kind of funding as I started working in September 2019. Am I missing something?
Right, so with this, what they were doing was if your employment income was more than your self-employment, then all those people never got the grants. So if you, like your 2021 tax return, if your self-employment income is a lot more and it's more than the employment income, then you would get the next grant. But if you're earning more employed than you were self-employed, then a lot of people didn't get it.
Right. Yeah. Good stuff. Okay, next one for Chris. What's the benefit of moving my old pension pots over? I'm confused as to whether or not I should or shouldn't.
Yeah, there's a few things to think about. Typically, the main benefit is the peace of mind of having it all in one place. This issue I mentioned earlier of £20 billion of lost pension pots, and that's because you leave a job 10 years ago and you'll lose the paperwork, and it's very hard to track down. There's no central database that tells you who the pension provider was or gives you a record. And you know, although that money is still yours forever, until into the rest of your life. It's, if you can't find it, you can't find it. And so if you're in that position where you have a few different pension pots from different providers, having it all in one place is peace of mind that you won't lose it. And also having it all together helps you know that the total amount that you've got, and gives you more control over how that's all is invested and things like that. But so the main benefit really is peace of mind and having it all in one place. There's a couple other things. Some different providers charge different fees. So some of the traditional providers might be charging quite high fees, and there might be hidden fees as well. So when you come to take money out of the pension, there might be payments or costs to doing that, because a lot of the more traditional providers might not be so upfront about the fees that they charge you. So if your other pension pots are charging a higher rate, then consolidating means you pay less money in fees. And then the one thing I suppose you need to be, well, the other one is that how your money is being invested. And so again, a different pension provider might invest your money in a different way, in a way that might not be in line with your sustainability and your ethical beliefs, but also might not be investing it in a way that's good for your pension pot. If you Nest is a pension provider that a lot of people will have come across because they're the government-backed workplace pension scheme. They don't invest your money in any to achieve a return for the first 5 years that you're with them. They keep it in a very low risk investment fund, which doesn't grow at all, and that's supposedly so that it can get you used to the fact that your money is invested. Whereas actually, it means you're missing out on 5 years of growth. So there are things like that where not knowing or the way that your money is invested with other pension providers might not be what you want. So it's important to think about those things. If you have a public sector pension or one from quite a long time ago, there may be other benefits attached to it. So you've got to be careful when you transfer, because you might lose some of those benefits. They're not particularly common with pensions, that have, if you've worked somewhere in the last 10 years or so. But it's always useful to check whether you would be losing entitlement to anything if you were to consolidate. So those are the reasons.
And I think, you actually in that, I think, addressed Mark's next question, I think. So it takes us on to the next one, which is something I was going to ask you myself, actually, Chris, which is it okay paying into a pension from a personal account rather than a business account for the time being? It's a good question, that.
Yeah, I think I saw the question because you're going to be moving to a limited company. Yeah, look, both are okay at any time. You can pay in, even if you have a limited company, you can pay in from your personal account or from the business, and there are pros and cons of both. If you pay in from your personal account, you get the top up from the government. If you're paying it from the limited company account, it just goes in, and because you've not paid any tax on it, you get the full amount in your pension, and then you get the tax offset on your corporation tax bill. Because there's so many different taxes, you've got dividend tax, you've got income tax, you've got and you've got the top-ups. When you work it all out, if you have a limited company, more likely than not, you're going to be better off by paying in from that limited company. But it's a little bit better off. If you were to pay in from your personal account, you still get the great tax relief from HMRC. So you can do both, and yes is the answer to the question. You can pay in from your personal account now.
Brilliant. Yeah, so this next question is something that we get a lot actually on our support channels, and we don't always know the best answer to this. It'd be great to find out what both your thoughts are on this. Are there any resources or lists online that advertise what costs can be claimed as expenses for digital freelancers outside of the obvious equipment and home office? Hannah, do you have any thoughts on what resources would be best to recommend?
I've never came across like actual lists. It's all like person to person. It depends on what they're spending their money on. I don't know is there anywhere I can give my email address out and I could look for them, or I could just send them a list myself. I'll make one for them.
Yes, I'm sure it'll be possible afterwards, right, Chris, to be able to send that out to all the participants, and then obviously further to that we can.
It's just off the top of my head. I couldn't direct them anywhere.
That's fine. Yeah, no problem at all. I was just curious because it's something we get a lot, and I don't know myself, but maybe there just aren't any decent lists online.
Digital people are usually the ones that have actually got hardly in, like their main expenses is like software and their office stuff, and then a mobile phone. But apart from that, they don't really spend money on anything that's like business.
Right.
So it's usually like looking through everything and like scraping it all out.
Yeah, that makes sense. So yeah, we're pretty much out of time, but there are just a few that I just wanted to quickly. How much time have you both got to answer questions? Yeah, all good. Okay, great. Let's just go through a few more then. So. Yeah, so the next question was, I became self-employed in 2018 to 2019. And when I submitted my tax return, I didn't earn enough to need to make payments on account. My income has increased for 2020 to 2021. Will I be charged interest because I haven't made payments on accounts for this tax year?
No, sorry if I've confused you. So what happens is 18-19, if your tax was less than £1,000, then there wouldn't be advance payments. But what will happen is when you do your 2021 tax return, if the tax is over £1,000, I call it a balloon payment. It's the biggest one you'll make because you've not got anything to offset against it. So this tax return, if it's above £1,000, the payments to account will then come in, and these will be towards next year's return. And they'll probably be the biggest payments you make because next year you'll have these payments to offset against it, and it will bring it down. But no, you won't have any interest. You'll just see that the payments to account will pop up on your 2021 return, and now you know what they are.
Brilliant. Thanks, Hannah. So there's a few now for you, Chris. I don't know if you want to just try and group these together. There's one on merging pensions and PAYE, one on state pension and personal pension, and then one on someone who's been made redundant during COVID. Sorry to hear that, but great that it's been useful in terms of motivating you to start your pension back up. Chris, if you want to just take those.
Yeah, if I can see them. Yes, so can we merge pensions to people who are on PAYE? Yes, we can. I mean, you can, even if you're currently working under PAYE for an employer, you can still open a Penfold pension and pay into it, and you can combine your previous pension pots using Penfold. The thing to watch out for, though, is if you're part of a workplace pension scheme, because you're on PAYE and your employer has to provide you one, you should make sure that if you can afford to, that you pay in the amount that the 5%, because it means your employer will add 3%. So you're sort of, if you don't pay in there, you'll be missing out on free money. So it always makes sense to make the most of the free matching you're currently getting from your employer. But there's nothing to stop you from opening up a Penfold, a personal pension on the side to use as the basket into which you tip your old pension pots. And yes, we can merge pensions from any employer into Penfold. Can you get both state pension and personal pension? Yes. So state pension is basically an income that I kind of look at it as like a grant from the government, just income that they send you each year or each month from the age of 68, depending on when you were born. And then your personal pension is really, just think of it as a savings account, really, which the government also pays into. So you're building that up into a large pot that one day you can then start drawing money out of and using as to supplement the state pension and to use to live off. So yes, you can have both at the same time. And then been made redundant during COVID. Been employed for 17 years. What's the minimum I should be putting into my pension to make a difference to the future while I'm still setting myself up? There's no minimum. I would say, if you can afford to save, then anything helps. And you think about it like the money that you pay in tends to double every 10 years if the investment growth is there through this compounding. So if you've got 30 years and you manage to put £1,000 in now, then that should turn into £4,000 after 20 years and £8,000 by 30 years. So it's whatever you can afford to put aside, and in the knowledge that you can then build up would be the best, because obviously because you can't take the money out until you're 55, you don't want to, you don't want to be in a position where you can't afford to live today, or you don't have that sort of rainy day fund to live off if something like coronavirus happens. What changes, if any, are on the horizon or in discussion for pensions for freelancers / self-employed? None, really. There was some talk about doing what's happened for workplace pensions, where with auto-enrollment regulation, where the government made it an obligation for every employer to create a pension scheme for their employees. That's been great for people in employment. There was some talk of the government mandating a pension scheme that all self-employed people had to open, but I don't see that going anywhere, to be honest. There might be, but the government does see it as a huge crisis. They call it the self-employed pensions crisis, that there are 5 million people who classify as self-employed in the UK, and only 14% are currently saving into a pension. Only 30% have any pension savings whatsoever. And so the government is looking at ways to address that. We're obviously looking at ways to address that too, but nothing concrete coming up. And then I've recently started freelancing, coming from full-time employment. I've not thought about my pension. I'm not sure if I'll be freelancing forever. So any caps, restrictions on how much or often you can consolidate or switch your pension providers? No, you can switch your pension providers anytime, but some pension providers charge you a fee to switch, which is the other thing I should have mentioned earlier that you should be careful about. If you're moving your pension from an old provider, and a lot of these, they've scrapped these charges because they're very unpopular, and they're for obvious reasons. We obviously don't charge people to switch out, but it could be a couple £100 that your old pension provider charges you. So if you've only got a few £100 in the pension, it would be disastrous to have such a high charge. So that's one thing to watch out for. Most of them have scrapped them recently, but that's the only restriction on how often you can consolidate. Okay, I think that's all of the pension ones in a row.
Yeah, I think that there's only a few left now, so if it's right with everyone, we may as well just just cap them off. Just go through these last few. So next one, I'm interested in info about mixing up taxation, usual long contracts work plus some personal where taxes and all is managed by company plus some personal extra work I invoice myself. Do and can I have to register as self-employed, and can I still continue as a contract employee? And can I deduct from taxes my software licenses? I think there's quite a few questions embedded in that, Hannah. Not sure which ones you want to take first on that.
Where is it? I can't find it.
So 138.
Oh, it's in Q&A. I'm in the chat, I think.
Do I have to? So I think they're asking essentially, if they're taking on long contract work, do they have to register themselves as self-employed, or can they continue as contract employees? It's this grey area over long contracts versus actual employment regarding tax. Well, I think, Hannah, you might be on mute.
Can you hear me now?
Yes. Now we can. That's better.
Right. So if it, when they say invoicing themselves, I'm assuming they mean they've got a limited company.
I would imagine so. Yeah.
Right. Well, you shouldn't really be, if you've got a limited company, you shouldn't really be invoicing the company for yourself. And if you have been invoicing the company, then that's technically self-employed, and you should have been declaring that. If you've been invoicing the company as a self-employed person, is that what the question meant? They've been invoicing themselves.
I think I'm not totally sure from the phrasing.
Sorry, I can't hear you. You've went mute.
Oh, you at the moment. Can you hear me now?
Yeah.
No.
Oh, okay.
I can read the subtitles, but so I can see what you're saying.
Okay. Well, yeah, let's see. I think whoever asked that question, I've written down all of these questions actually, so we can, any that we haven't come to, I can always provide answers to them afterwards. But one of the ones I was, so there's two here I was particularly interested in just covering. One was that, so Valerio's added a clarification that actually they forgot to mention that they lost a teaching job due to coronavirus and tried to request some money, but was unable to get any because they were working for a limited company. Is there any way to get some money in? They're in kind of a limbo situation here, so any assistance would be appreciated, I think, on that one. Hannah, do you have any thoughts on that?
Chris, would you be able to read that out and I can see if I can hear you?
Can you hear me okay?
I can't hear it.
Well,
could you copy the question into the chat and then I'll just answer it from there?
I think what we can do is any further questions we can just send through Hannah, and then we can put the questions and the answers to everyone after this. I've collected them all together, so I can send them over. There's just some, Chris, might be worth just dealing with now. One is it correct?
So that I'm assuming that you meant.
Oh, sorry.
You were working for a limited company, as in the teaching was a limited company. Right.
Can you hear us?
So you weren't working as self-employed then. So if it was your limited company, it would have been the bounce back loans that you would have had to apply for. And if you had an office, there would have been a council grant that you could have got for £10,000. That's if the company was trading before March. If it wasn't your limited company, then no, the only thing you could have got done was being put on furlough. I'm just looking. If you are submitting a 2021 tax return and there's no income from that limited company on it, then you will get the next grant, and that could maybe help you out. But if that limited company was yours and it wasn't trading before March, then there was no support for those companies.
Okay, brilliant.
I was working as self-employed for another limited company. They said I was not eligible as furlough. If you were working as self-employed, then that company hasn't been putting you through the payroll, so there is no furlough, and that company has been expecting you to declare all that income they've paid you onto a tax return. So you should have been registered as a self-employed person and been declaring that as self-employed income, and it would have been the self-employed grants that you should have been applying for, not the furlough.
Okay, brilliant. Thanks, Hannah. Yeah, Valeria said that's great. Thank you. So, Chris, there's just two more, I think. How does the pension work when you've worked abroad before moving to the UK? And then also, is it correct that I can only transfer my pension to you? And then I'm not sure the second bit. You won't find them as such. That's something I need to do before transferring. Not. Yeah, I don't. The second one, I suppose it's mainly, is it correct that I can only transfer my pension to you? And then how does the pension work when you've worked abroad before moving to the UK?
Yeah, so the UK pension scheme, so the pension schemes are different in different countries. And if you worked abroad, you may have, depending on where it was, built up some pension savings there. And again, depending on where it was, you may be able to access those pension savings again in that country, or get them transferred to the UK. And once you move to the UK, no matter where you're from, or even where you want to live in later life, you can, as long as you're paying taxes in the UK, you can benefit from the UK tax breaks available if you're tax resident in the UK. So you can open a personal pension and you can pay into it and you'll get the government top-ups. You can then access that money in the UK once you turn 55. If you move abroad, say 10 years later, you're in the UK for 10 years, you're saving into a pension, and then you move abroad before you're 55, you can also, many pension schemes will let you transfer from that amount from the UK pension to a qualifying registered overseas pension. So a QROPS is what they're called. So there are particular types of pension schemes in different countries that you can move it to. But that money is always accessible if you were to come back to the UK and draw it out into a UK bank account. And then, no, you don't have to, if you're combining pensions, you don't have to just send them to us. We're biased and we think we're a good place to do it, but there are other pension providers you can obviously transfer your pension to. I think we try to just make it as pain-free as possible, and you know, no paperwork, no call waiting, no fees to do it. So we do as much of the heavy lifting as we can for you. But yeah, there are other places you can combine your pension.
Brilliant. And then yeah, the very final thing, I think Nanine's got a really good question that ties into actually me just doing closing things out, which is can you find my pension for me, or is it something I had to do myself before consolidating with Penfold, just trying to understand the service Penfold offers? And then that would, yeah, ties into me just explaining why you should both use Penfold and Tax Scouts. Yeah, so Chris, if you could just...
Yeah,
that would be
yeah, absolutely. The key information is who the pension provider was and your policy number. If you have that, you give those to us and we handle it for you. The pension consolidation, the transfer from your old provider can take about 10 days at that point. A lot of people find that they don't know one or both of those bits of information. And so our customer services team can help you find that information. We're also building tools that we're hoping to release in a week or two, where within the app you can just enter the name of the company you worked at, and it tells you who the pension provider was. Because once you know the pension provider, as I say, either we can send a letter for you to the pension provider and they can give us your information, or that takes a few weeks and some of them don't even reply to them. The most effective thing to do is what you giving them a call saying, this is my national insurance number, what is my policy number, and they have to give it to you. And that's by far and away the most effective way to do it. We could promise to get it for you, but it just takes a lot longer, and we can do it for you, but it just takes a lot longer. So as long as you know who the provider was and the policy number, super easy, we'll do it for you. If you don't know there's information, our customer services team can help you find it. But at some point, to speed up the process, giving a call to that pension provider, if you don't know the details, is the fastest way to get it done.
Brilliant. Well, thanks so much, Chris and Hannah, for providing so much insight there. Super valuable. So yeah, just to close things out, you know, it's so important that you both get what your tax, your taxes all sorted. It's the biggest thing our freelancers come to us with issues about. It's super important, and also looking after your finances for the future is critical, particularly if you know you're just starting out and unsure, you know, what you're going to do in the future. Like Chris said, being able to take control of your time and do, you know, in the future take on the projects that you want to, because you've got that financial assurance is critical. So just wanted to close out on that. Thanks so much, everyone. We will be sending over a recording of the webinar, and also just any questions that we haven't answered, I've noted them all down, so we will put those in further communication. So have a great rest of the day, everyone, and thanks again. Have a good one. Bye for now.
Thanks very much. Thank you.
Bye.
Bye.